This is Invested in Climate with Jason Rissman. I see climate as the world's biggest, most diverse, most important movement in human history. Millions of people dedicate themselves every day to protecting the planet. This podcast shares conversations with advocates, entrepreneurs, investors, policy experts, and anyone else that can push our thinking about what's possible and what needs to happen to address climate change. If you have ideas for episodes or feedback, get in touch on LinkedIn. If you enjoy the show, please leave a rating on Apple or Spotify. I'm currently building a new venture. It's related to storytelling and how we engage all sorts of folks in meaningful climate action. If you have expertise in this area, big ideas, or examples of something that's really working, get in touch. Thanks for listening and for doing whatever it is you're doing to support climate progress. Okay, let's get started.
For the near term. So what does that mean for Spring Lane and other investors like us? I think one is, just to be frank, we have to fight like hell to tell our story to policymakers. And it's not just around the kind of, again, when this podcast is launched time frame, but in the medium and long term to make clear that what we're doing reduces energy costs, helps the US compete with China.
Hi, everyone. We're back with another episode in our series on the missing middle in climate finance in partnership with Spring Lane Capital. This is the third episode in the series. If you didn't catch the others, check out investedinclimate.com/series, and you'll find episodes that go into the research on the missing middle produced by Creo and S2G. If you have ideas for other series and would like to partner, get in touch through the website as well. For today's episode, we're joined by Spring Lane Capital partner and entrepreneur in residence, Jason Scott, and Mark Berryman, who is a partner at Capricorn Investment Group. Capricorn is part of the OG of sustainable investing, having been leaders in the space for over 2 decades. They have over $12 billion in assets under management, and so this episode was a fascinating conversation between a large asset allocator and a smaller, nimble firm with a specialty in project finance and growth stage venture capital. Mark was recently selected by Impact Capital Managers as LP of the Year, and I'm really grateful Jason thought to invite Mark because his perspective brought a lot of nuance to the challenges and opportunities to fill the missing middle gap. Lots to learn in this one. Here we go. Enjoy. Jason and Mark, welcome to Invested in Climate. Great to see you both. And Jason, welcome back.
Thank you.
Well, we had a great first conversation with Regine Clement of Creo in the kickoff episode for this series on the missing middle, created in partnership with Spring Lane Capital. It's great to have you back. And Mark, it's great to meet you. Before we dive in, let's do a quick memory refresh. Jason, give us a quick reminder of what the missing middle is, what Spring Lane Capital is, and why the missing middle is relevant to your approach.
Sure. Thanks, Jason. Hopefully these conversations build on each other. Really enjoyed the conversation with Regine, and the response has been fantastic. I think a good way to look at the missing middle from my perspective is what my colleague Rob Day from Spring Lane Capital wrote a couple months ago, which is there's actually several missing middles, and they get wonderfully conflated. One of the missing middles is around the technology adoption for new projects, what some people call FOAK. Another missing middle is deployment of capital of projects where the technology has been proven, but maybe not deployed at scale. And then the final is a missing middle in growth equity, where we see a big gap between smaller growth equity firms and the big buyout or private equity or energy transition shops that have raised many billions of dollars. Spring Lane operates a little bit across all three, but mostly in the second two, not in the first. So we're really looking at companies that have deployed projects maybe at a smaller scale of proven technology, and they need both corporate equity and project finance to scale their businesses to a point where some of these big energy transition or private equity firms could come in and take them to a very large scale.
Great. Fantastic. Thanks for kicking off with such good clarity and also helping remind us of how varied the problem is, but also where you are most focused. You get the credit for thinking to invite Mark for this discussion. Give us some context. Why did you think he'd add to this conversation?
Sure. Well, Mark, first of all, thanks for agreeing to join us. Mark and I have been friends and colleagues for, I'd say, a few decades, but that'll make us sound older than we'd like to think we are. We've spent a lot of time together, both commercially and also more broadly talking about climate and some of the issues why we're in this work. And so I know he's both mission aligned and commercially aligned with what we've been working on at Spring Lane and Creo for many years. His background includes hopefully some of what he'll pull out at the IFC for many years, but more recently at CapRock and now at Capricorn. I think he's one of the fund allocators who is most respected in the impact and sustainability world. I think I'm allowed to call out he was Impact Capital Manager's Manager of the Year or something close to that. You can correct me later, Mark. But in all seriousness, I think he's one of the folks in our space who fund managers most respect for his ability to kind of see through the noise and pick managers who are really solving a very specific problem and have the right amount of experience, track record to make a fund work. And he's not afraid to take risk on new managers and emerging managers, or also double down on experienced ones if he thinks they're the right ones to invest in. The final thing I'll say about Mark is he's one of the folks who I really rely on to talk to people who are new to this space, to asset owners and asset allocators, to family offices and foundations, about how to allocate their capital across the investment spectrum, public equity, private equity, funds, directs, equity, debt, to be aligned with their mission, especially around climate. So I think he brings both kind of the manager selection perspective, but also the kind of whole portfolio approach to climate solutions experience.
Thanks, Jason. Mark, no pressure. Hopefully accurate, but hopefully also didn't
LP of the year, Mark. LP of the year. I think that's it. I was there. I should know.
Yes, our first time getting to meet an LP of the year. We'll get to hear more about that. Mark, no pressure. Don't let Jason's high regard make you nervous. But let's get started by hearing in your own words a bit about your background. And you recently started a new role at Capricorn Investment Group. For those unfamiliar with Capricorn, tell us a bit about the firm and the role that you're playing.
Great. Do you want me to start with any other aspects of my background? Although Jason just put me on a very high pedestal that is not deserved. He mentioned decades, and well, I start with that sentence. So I started my career 20 years ago as a Peace Corps volunteer in Mali, West Africa. I was based in an incredibly remote Dogon village, 120 miles away or south of Timbuktu. And despite my main role being microcredit at the time, it was my first kind of really exposure to the climate crisis. And that's what people were calling la desertification. It's a former French colony. And so they were already aware that the desert was taking over the Sahel. And that was going to have massive ramifications from a food and water perspective. And again, I didn't think about it at the time, but it is just so, present today, and not just in places like the Sahel, but everywhere. I think that international experience led me to one of my main jobs in my career, which is the International Finance Corporation, which is the private sector arm of the World Bank, where I was in the group called FIG, the Financial Institutions Group, that invested in funds, banks, insurance companies, and any other kind of financial sector institution. And all over the world, I was based in China for a bit, Istanbul, Turkey, West Africa again, in Washington, D.C., worked for a few years at Deutsche Bank, believe it or not. And Deutsche Bank was one of the first banks to really have an impact strategy in city. I think it's a very different world today with other banks leading the charge, but Deutsche Bank was one of the first. So I spent a few years there before going back to the IFC for a handful of years. But most recently, as Jason alluded to, I spent about 8.5 years at CapRock. CapRock is a multifamily office and really was one of the early movers from the multifamily office universe to have impact investing a key component for its family and foundation clients. And so it's there where I spend a lot of time as an allocator, as Jason hinted at, investing in funds, right? We're investing in funds for all the right reasons in terms of diversification, but also investing in the experts. My job is to be kind of a portfolio investor, thinking about asset allocation and allocating capital to the best in breed, depending on what that sector or asset class would be. And so through that period, good Lord, we invested in well over 100 different kind of impact opportunities, mainly funds, and about 36 plus climate funds. And so that's where Jason is kind of probably overemphasizing my experience in the industry. But it was, again, through investing in top tier climate funds, in real assets and venture capital and private equity. But yeah, I'm super excited about this new role. And I think right when I joined, Jason wanted to tee this up, and it's super fun. I think a lot of people know Capricorn as being incredibly smart investors and truly a leader in climate technology investing, being some of the first with over 2 decades of experience in doing so. The other thing here is Capricorn truly is like a first mover alongside PO Meteor. And that is because one thing that is well known is Capricorn historically was the family office for Jeff Skoll and the respective entities part of Jeff Skoll, the Jeff Skoll Fund and the Skoll Foundation. And as a result, really was a first mover in creating a fully aligned impact portfolio. And so I'm coming here and I'm really stepping on the shoulders of the largest, in terms of what it does today for other clients, the largest completely values aligned outsourced chief investment officer in the industry. We call it OCIO in the industry in terms of building, allocating, and managing values aligned portfolios. And again, it can be different from everybody. Some can be 100% climate aligned. Some could be a mix with social solutions, or some may want to veer towards more social solutions. It really depends on the financial and the impact objectives of that client. And our clients are ultra high net worth individuals, family foundations, and in some cases, institutions are coming to us to help create like a climate endowment type portfolio. So again, I'm super excited to be here. I came over with a colleague, Nick Flores, who led a lot of our impact advisory work at CapRock. And again, building on great years of experience here from the Capricorn team.
Thanks, Mark. One last context-setting question is, of course, your connection to this topic of the missing middle. Is the missing middle something that you're focused on, that you focused on previously? Is it new to you now that you're a Capricorn? Give us a sense of your history with this particular investment stage and opportunity.
Great question. And I joke about this one, and I think I joked about it with Jason. He's like, well, you cannot say that in this discussion today, but like, I think the missing middle is sometimes overused and misused. Like, I first heard about this word called the missing middle 20 years ago because it was coined by the World Bank. It was for companies that had outgrown, let's say, microfinance, but couldn't get a loan at a commercial bank because commercial banks were only doing corporate lending. And so you have this missing middle, but it was mainly, again, small and medium enterprises that couldn't get a bank loan. And so I kind of joked, I was like, well, is this different now? And I also see it, as Jason said, it's often conflated with first of its kind. And I see these as very different things. Just like when people talk about emerging managers, they often kind of accidentally say that's also like diverse managers, meaning asset managers led by people of color, and female asset managers are the same thing. Like, they can't be the same thing, but they are inherently different. And so I do think the word missing middle can sometimes be abused. But listen, it has a rightful place right now. And that is because we have a large portion of climate asset managers being early stage venture capital funds. But we don't have a lot that are really supporting those businesses scale and commercialize. I want to say there were like 290 early stage and venture capital climate funds, but like 30 plus, even if you can kind of take that number to the bank, 30 that invested in growth stage or later stage. And so you can imagine there is this missing middle there. And unfortunately, in 2021, 2022, there was a little bit of FOMO in the market. There was a rush to do climate because it was so in vogue. Everyone was doing it. And so what's sexy and fun is the early stage stuff, betting on new technologies and repeat founders, but without thinking about that kind of next level. And in some cases, people were repeating the mistakes of 2007, 2008, right? Venture dollars for more CapEx heavy type companies without thinking about follow-on capital. And is there another later stage for this type of company? And so again, while I do think the missing middle is overabused, it is very, very present today. And it's very clear that we have a lot of climate-focused companies that got early-stage venture backing that are a little bit stuck. And they're in a little bit of a glut because they can't raise more capital right now because the supply isn't there, or at least not nearly as what it should be given the kind of capital that went into early-stage companies.
Thanks, Mark. Jason, in our first conversation in this series, we focused on Creo's really comprehensive 2024 report on the missing middle. One thing that it highlights is the importance of mid-sized firms with funds of less than $1 billion in assets under management being really particularly well suited to helping fill the climate financing gap. Can you help explain this dynamic for our listeners?
Sure. There's, I think, two different dynamics going on that create an opportunity for the missing middle gap to be filled by smaller and even what one might call emerging managers in the context of the whole private equity ecosystem. I think the first is the natural urge of all asset managers to gather more assets. So, everybody wants to double their last fund or triple it if they can get away with it. And sometimes that's good. Sometimes there's a proven strategy that works at a higher level, or one can replicate the same type of strategy, but put more money into a company, have more control maybe. So it's not that it's always a bad idea to grow assets, but I think in the recent past, I think in the climate space, quite a few people have started with funds that were sub-billion, or even some of the big private equity complexes have started with funds of $1 billion or $2 billion and are now at 7 or 10 or 15 or $20 billion, right? And so they've now been reduced to writing checks at a minimum that are a few $100 million, which I think puts them out of what we see as the missing middle gap, according to the CREO research, and certainly where Spring Lane sits. I think the second reason there's an opportunity for smaller managers is that investing in the missing middle, investing is hard. Investing in the missing middle is a little bit harder. It's a little more unbanked. It's a little more entrepreneurial. It's a little more risky than investing in deeply proven technologies, plants 5 through 10, or at a certain scale where you can afford a lot of operational support, consultants, things like that. So people tend to shy away from those types of deals if they don't have the resources to really do the hard work to bring these companies through the missing middle. And so you do get this bifurcation, some of which Mark explained, between the venture firms that are doing the riskier, some might say sexier or exciting stuff, and the bigger PE and infrastructure firms are just like, that seems like a lot of work. I think our view, and the view of our view as Spring Lane, but also for the research from CREO, says that this gap of kind of fund managers that are sub-billion, but specifically funds that are kind of in the, I don't know, marking correctly, like $150 to $750 million, allows you to write kind of the $20 to $150 million checks that are often missing in the capital formation process. Once you get to where you need a few hundred, there's a really interesting group of big asset managers who can write those checks. And happily, I think even despite the current macroeconomic and policy uncertainty, those funds have a lot of what people call dry powder. So if you can cross the missing middle gap, there's a lot of places you can go, but kind of in that gap, there are very few managers because of the, I think, natural tendency of funds to grow big and the difficulty at that stage of investing.
Thanks, Jason. What's really interesting to me about this conversation is the different vantage points you both bring. Capricorn is a $12 billion investment firm, while Spring Lane manages about $300 million. Mark, I'd love to hear from your perspective. Tell us about how the team at Capricorn sees its role in filling various financing gaps in climate investing, both in terms of both the market opportunity as well as climate impact. And tell us how you see your role in this ecosystem.
So are we talking about how to create like a climate full portfolio, or like what are we doing to support the missing middle?
Both.
Both?
Yeah, both.
I'll take the kind of more portfolio approach first, and then talk about some of the fun stuff we do in supporting the ecosystem by filling this gap. When people think about having a fully aligned climate portfolio, our job is to come up with very clear asset allocation. And that's going to be a portion in public equities. And then in that regard, can you have a climate lens there? And the answer is yes. Over time, as some of these innovative technologies become public entities, you will see a larger portion of positions that people can take in very clear climate solution businesses. But right now, in many cases, you still have to have a Microsoft in there. Why? Because they're trying to power all their data centers through renewable energy. And so are you investing in a solution in public equities? Not necessarily, but it still can be values aligned from a climate lens perspective. The same goes with fixed income. Or you could think about some unique muni bonds that are in various parts of the country that are investing in climate infrastructure and having that part of your portfolio in terms of fixed income. And then that's where you move into the fun stuff where you're actually investing in solutions. And we'll talk about long-term investing in a minute here. That's in real assets, and that can be core plus, that can be value add. It's going to be in private equity. It's going to be in private credit, a growing area right now, I believe, in climate investing when we think about portfolio allocation. And of course, the fun stuff where we had so many dollars come in over the last few years, which is the venture capital space. And in some cases, doing some direct deals as well. You may say, well, okay, let's also go back to the beginning. You also can think about interesting things to do with your cash, right? Parking your cash in various green banks that might still have FDIC insurance or NCUA insurance, to have that part of your portfolio also fully aligned. And so that is our job. That's what we do for our clients, to have that fully aligned climate portfolio. And yes, you can execute it across all asset classes. And in some cases, you can even get a little finer. For example, you could have an agriculture family or someone who cares about water. Like, okay, I want to climb a portfolio, but now can even add another lens of water in there. Now that is difficult. It just requires more patience, but you actually can have a pretty cool like water lens portfolio at the same time. And so again, that's a kind of portfolio approach to building on a climate portfolio for our OCIO clients. On the missing middle component, I think this is where it's super fun and something Capricorn has done for, good Lord, well over a decade. And that's kind of filling the ecosystem through what we call like responsible stewardship or ecosystem building, essentially backing GPs, right? Helping a certain strategy get launched. Why? Because there is a missing part of the market. And that started, again, well over a decade ago with a very well-respected top decile real assets group, climate real assets group called Vision Ridge that Capricorn helped launch in 2014. They take a unique kind of PE approach to climate real assets. And it has done very well. I mean, I was fortunate to invest in their funds as an LP in prior roles, and they have just done, amazing work. And so that's the fun work that Capricorn can do in kind of building out the ecosystem. That includes other groups like SCR Partners, Astonor. We gave them GP capital to help them launch their growth strategy, right? And that's going to help fit that missing middle. Most recently, in February, Capricorn took a GP position in Closed Loop, a very well-recognized leader in the circular economy. And this is to help them develop strategies for further funds. Either it could be real assets, it could be growth, it could be the missing middle, it can be venture. And again, with this very clear circular economy lens. And so again, this is kind of that fun stuff that Capricorn gets to do by backing GPs who may want to create an opportunity fund. Why? Because they see a gap that's out there in the market, and our financial support will help them do so.
A lot there. Excited to dig in more. And Mark, Jason, this is actually the part of the interview that I'm most excited for. I get to get out of the way and let you two ask each other some questions and surface insights. And I'm excited just to learn from you both. Jason, why don't you take it away?
Sure. And Mark, I really appreciate you again taking the time to talk about this. I think for a lot of people who'll be listening to this, they're probably either aspiring or younger or growing fund managers. And what I have always admired about your approach to this is not take any meeting, just to be clear, but take a meeting with an aspiring or emerging manager and hear them out where a lot of people won't. And obviously, having the GP investment capability now is an exciting way to kind of action helping grow some of these firms and grow the space. But what do you look for in a manager when they walk in for a first time or a second time fund? And most people just won't even have the decency to return an email, much less take a meeting. Give folks a sense of what you're really looking for when someone walks in the door with that pitch.
I believe in always taking meetings when you can, unless it is like a nefarious individual or, selling something toxic that is just not going to go anywhere. I think by taking meetings, we all learn. By knowing who the players are in a specific lane is more information for myself. Or even if we cannot invest in that specific group at that point in time, I'm a huge fan of working with our peers. That's other financial institutions, other family offices, and being a reference or sharing pipeline. And so we'll always take those meetings because, again, I think it's valuable for everybody involved. Listen, I think despite where we are in this kind of uncertain period, we're unique in that, investing in climate solutions is a lot better than it was in 2016, 2017. Back then is when we saw a lot of expert climate funds really start their first fund. And so when I was trying to figure out how to invest for climate back then, it was harder. Like you could count the folks in every respective asset class on your hands. Now, today, it is a lot easier. Now, it's hard to know how good someone is yet until they're kind of at fund 3, right? Even when you're kind of looking at fund 2, you're really still looking early stage of that, climate asset manager's progression. Why? Because maybe they've only invested 60% of their first fund. It's hard to tell. Were those good investments? Are they going to scale? Are they going to grow? Do they know how to exit? It really takes to get to that third fund to really know, hey, this team gels, this team is smart, this team knows how to exit, and they're thinking long term. So it is a challenge when meeting with emerging managers in that regard. And so I think today we're lucky because we can look at that. We now can look at a fund 4. We can look at a fund 3 and actually look at that track record. That being said, there will always be a niche that needs to be filled where there is not necessarily enough opportunities out there. For example, climate funds that were fully focused on resilience and adaptation was still new just a few years ago. And so you kind of had to start with investing in a first-time fund manager. in that regard, you're going to want to look at their track record before. Have they worked together? Because one big risk for emerging managers is this implosion, this key person risk, where people actually may not work well together despite them being experts in their respective domain for years. And so that is a risk we always take when investing in first-time funds, is that kind of risk there. But again, you still got to do it. We still have to look at first-time funds because there will always be a niche that needs to be filled when we're investing in climate solutions.
Well, you actually teed me up for the second question I wanted to ask, which, things have changed so much since we started in this field, 15, 20 years ago. I am curious because you talked about the total portfolio management or climate endowment model that you're pursuing at Capricorn in different ways. Maybe you can tell us a little bit, like, what is the case that now you can invest a portfolio, if you're talking to an asset owner, a CIO of a foundation or a family office or a pension fund, what's the case that you can actually replicate the risk return asset allocations that you've had across your whole portfolio into managers that are, or products that are climate aligned?
It's a great question. And again, this is where I'm fortunate to be where I am at Capricorn that has been doing this for 20 years. And as a result, we have the financial results to show that you actually can construct and manage a fully aligned portfolio with a complete climate lens to it and actually deliver not just market rate, but better than market rate risk-adjusted returns. And I think that's the powerful message that, yes, it is possible. Yes, you can invest across all asset classes for climate solutions and deliver an above-market risk-adjusted return. Secondly, as part of the infrastructure on the fluffy side, I don't want to call it fluffy, but a lot of old school hard-nosed investors may forget about why we do this, which is the kind of impact climate reporting. And the infrastructure around that continues to improve. Despite advancements over years and years, we still have ways to go, but we now can get aggregate climate impact KPIs on a portfolio level and drill down to a company level and figure out where there are like-minded KPIs across the companies and aggregate those up to tell a really compelling story that asset owners can not only hit their financial targets, but look what they've done in terms of decarbonizing or mitigating or adapting to the planet with pretty unique KPIs. Again, trying to standardize them for comparability, just like you want comparability for financial returns. We continue to have improvements there and show proof in the pudding. Not perfect, but we continue to have advancements. And that's going to be really compelling to mobilize more asset owners to build a climate portfolio, despite excitement, but fears.
I'm going to kick this back to Jason, but I will say from a Creo perspective, just being on the board there and watching what we're doing, the next key layer of data that we're trying to provide to our members and to institutional asset owners is performance data. And there really is now, I think, finally enough performance data to make a dispositive case that you can do this across different asset types and products. Like you said, it's still not easy and it's still nothing is ever proven. But I do think after this really long amount of time, we are getting to a point where folks like Capricorn and other managers, asset allocators, and investment advisors in the space kind of make a real case that this is possible. And I do think that is something that has changed quite a bit in the last 5 to 10 years, so that we hope that evidence will help people move more money into climate solutions.
So Jason, if an asset owner or managing a climate portfolio and I'm trying to find a place for Spring Lane, where would I put that? Is that in the missing middle growth equity? Is this in private equity? Is this in real assets? Is this the value add component of real assets? Because I'm like, hey, these guys are good. They're investing in areas that others are not. There is significant upside here because of the disruption, the positive disruption where they're investing. How can I convince my investment committee? Where do I put this?
That's a great question. And it is a trick question, of course, because you can put it wherever you want so that you can write the check. But in all seriousness, I do think this is something that we struggle with and other managers like us struggle with. We are a private equity firm. We do write growth equity checks. We do provide project finance. We do invest in real assets. Some people would say we're on the kind of venture growth side. Some people would say we're at the early infrastructure side. And that kind of defying kind of bucket is a challenge. And I think it is one of the big challenges for the climate space in general, is that there are unique characteristics around investing in climate solutions that make it look like some things in traditional asset allocation and not like other things. Alternatives, illiquid alternatives, that could be a place you put it, because have real asset downside protection, structured solutions, structured equity, structured finance. So we've been put everywhere. I think we think ourselves really most appropriately in a private equity bucket, but I can make the case that we can fit in a lot of different places in a risk, depending on the risk return approach that a allocator has taken. And I'll just reemphasize once that this is a big challenge for the space. If we're going to solve the missing middle, quote unquote, and those three buckets, and I think we are more on the growth equity and the project finance side, less the folk side. But if we were going to solve that problem, we need to educate asset allocators that these buckets don't neatly fit climate. Some people compared it to biotech. That doesn't work. Like some people compared it to, small buyout. That doesn't work. So I think it's a struggle for the space. I kind of know where I would put us, but we're happy to be flexible depending on how an allocator views the space. And I guess that's the final thing I'd say is I think speaking as a manager and to other managers, it's really important to understand what the allocator wants to do and what problem they're trying to solve in their portfolio to figure out if you can fit there. Because we'll also say to people, hey, this isn't a fit for you. You're not looking for something like this. And last thing we want is an LP to invest in our fund who doesn't understand what they're getting into in terms of risk, return, and liquidity.
Well, let's go deeper into this, because I think this question of sort of bucket busting, line blurring, more or less innovation in how we're investing in climates and the need for it is really interesting. And Jason, what I think you're saying is that we need more of it, but that it's also challenging because then allocators don't necessarily know how to see you. Mark, curious if you see more of this and any thoughts that you have on the need for these sorts of category defiers, as well as how they should pursue it, given how investors will see them.
I love the question, and I love your honesty, Jason, of after the joke of just put us where you want us, but hey, this is a little bit of a challenge. And I will say this, and this is not just to kind of say this because Jason's here and we're colleagues and friends, but we need more spring lanes. And there are only a few ones that I would put in that kind of comparable category that are investing, and I don't want to use this word again, but positively disruptive technologies that really are going to shift how we think about energy transition and renewable energy infrastructure, as well as other adjacent industries. There are only a few, and I struggle too, but I would categorize them in this kind of private equity-like hybrid with value-add real assets. Because it is higher risk and you're adding more value, it is something new. There's development risk, all of these things that are not kind of core plus, but are kind of more opportunistic, like opportunistic real assets, private equity. It's where I put it. And there's only a few out there. We need more.
Guys, been enjoying the nuance here. Let's wrap up by looking both at the macro context as well as by looking into the future. Mark, we've seen tremendous volatility and change in the market. Trump's tariffs sparked a massive sell-off and decline of market prices, then a rebound. What ripple effects do you expect for climate investing? And what other macro factors do you think are most relevant?
That's a very difficult question. I think if I or anyone had an answer, the question wouldn't be asked. Listen, the tariffs are going to affect everything we do. This is not a climate issue. Does it affect the growth of numerous climate businesses in the United States and worldwide? Yes, but it is affecting everything. So it is a distraction and a problem. And I think when we think about all the momentum that we had for investing in climate solutions, we all know we're facing significant disruption right now and massive roadblocks that will drastically divert capital and resources from investing in more climate solutions over the next few years. And this is just going to affect how we all invest. I think it's important to keep in mind that this follows a sugar rush that happened a few years ago. Think if we were at 2022 right now with the IRA and all the capital coming in, we didn't see this coming, did we, 3 years ago? So I hope that in 4 or 5 years, we look back at this and say, God, remember that? Just like we forgot about the sugar rush and excitement and opportunity and resources, public and private, in 2022. That doesn't mean what is happening right now is not going to cause damage, right? It will. That being said, we need to think about long term, right? This is short term. Yes, there's damage. We need to think about the long term. The best investors are those that are disciplined. Disciplined investors commit for the long term. And if you want a climate portfolio, that involves investing in real assets, private equity, venture capital. And these are long-term holds, and in some cases, 12 years. So we will be on the other side of this at some point in time. Now, if asset owners and allocators did their job, they thought about investing in climate and different asset classes every few years, thinking about vintage diversification to weather this damage and disruption that we're going through. And so I am hopeful there. Secondly, climate is a macro trend. No matter what disruption we're facing right now or kind of damage that we're facing right now, this is a long-term trend. Just like AI, you cannot ignore it. And so more cost efficiencies, more capital will still continue to go into particularly the energy transition, despite some kind of roadblocks. And listen, despite all the hoopla out there, we don't want to be in second place or third place to Europe and China. And so I do think we will still have public support in some shape or form because we don't want to be in second or third place. And finally, consumer demand will not go away. Consumers will always want to and continue to seek more sustainable options in terms of how we eat, in terms of how things are made, in terms of where we live. And those trends will not go away, particularly with the future generation. And so despite the fear and frustration and the financial stress that this is going to affect portfolios, which it already has over the last 12 to 18 months, I do think we will come around the other side at some point in time, and hopefully sooner than later.
Thank you, Mark. Jason, what about you? And for Spring Lane, how is the macro context influencing your investing and your companies?
Well, Mark gave a really good comprehensive answer, so I'll give a more tactical answer, maybe a smaller picture. I think there's 3 headwinds right now that we're facing. One is policy uncertainty. And, this podcast is not evergreen with me saying this, but right now we're in the middle of a fight to keep the IRA from effectively being repealed. And not just the tax credits, but a lot of things that enabled a really amazing growth of investing in our space for very many years, and not just connected to the IRA, but connected to DOE, eliminating grants, rescinding the money for the green banks. So we are in a really challenging situation in the short term. So 1 is the policy, I think, challenges. 2, I think, is macroeconomic uncertainty. So obviously specific to tariffs and input costs, but more just generally, are we headed into a recession? What's happening in interest rates? And I think that really freezes asset allocators, especially from making investments. And then I think the third thing is, as Mark said, kind of the sugar rush is over. And so a lot of people have said, hey, we're having tourists leave the space. That's both asset allocators and investment managers who have the choice of whether they invest in this space or not. Energy transition can be a lot of different things to a lot of different people. Sustainability can mean a lot to a lot of different people. And so I do think I think the marginal investor is going to leave the space for the near term. So what does that mean for Spring Lane and other investors like us? I think one is, just to be frank, we have to fight like hell to tell our story to policymakers. And it's not just around the kind of, again, when this podcast is launched time frame, but in the medium and long term, to make clear that what we're doing reduces energy costs, helps the US compete with China, creates jobs. We're more solar jobs in West Virginia than coal jobs, all those kinds of statistics. It's true. And the IRA is building jobs in more red states than blue states and more red counties than blue counties. And so I do think we can never take our foot off the gas telling the story about the economic opportunity around investing in climate. And we did do that towards the end of the Biden era, and because there was this kind of sugar rush of money coming into the space. I think the second thing is that, look, we're lucky. We still have investments to make in our fund. we're very lucky that there's a lot of dry powder on the sideline in the big energy transition funds. So I actually don't think investment by fund managers is going to slow down too much. I do think the earliest stages might be hurt more than the growth equity and project finance areas where we operate. But it does mean there's going to have to be a lot more collaboration and coordination and co-investment with our peers, which we welcome. And then the third thing I'd say is we also need to make the case to asset allocators about the short and medium term opportunity to keep providing capital to manage in this space who might not have dry powder right now. Fundraising is really hard for LPs right now. To Mark's point, it shouldn't be. This is actually a great time to invest if you have any faith at all in the long-term dynamics around investing in climate solutions. There are many trends across the board. There are things that might get hurt more in the short term and some things that might benefit in the short term. We're looking at more waste to value deals and EV deals as just an obvious example. We have EV companies in our portfolio we continue to support, but we recognize that in the near term, there might be a lot of headwinds. So I think kind of tactically adjusting what we're doing is something that everyone else is doing, but we've got to constantly remind LPs and asset owners that like through macroeconomic cycles, through policy changes, these are long-term trends that consumer behavior, corporate behavior, policy is going to support and policy are going to support so that there are a lot of investment opportunities still. But don't get me wrong, it's going to be a tough time for the next couple months and maybe 6 to 18 months, depending on what happens from a more macro perspective.
Let's look a little bit further out. And as we close out the episode, looking 3 to 5 years out. And Jason, you made the comment that you think marginal investors are leaving. Curious, what do you both see in terms of this missing middle problem, climate investing in general, and the outlook for that 3 to 5 year timeframe?
No, look, I think the 3 to 5 year outlook is really exciting. I don't think we've had as high a quality of management teams and talent in this space ever. More and more people are coming into the sector. More and more people are coming into the market. I think the marginal LPs that are leaving will be back. The asset allocators that have slowed down will be back. So I don't think we'll have the same type of short-term capital challenges in the next 3 to 5 years. I also think that some of the longer-term trends we're seeing now started to come to bear around adaptation and resilience, costs coming down in areas, obviously like solar and EVs, cost of batteries, things like that. I think in the 3 to 5 year time period, I do think we're going to solve some of the grid and transmission and other infrastructure issues that are really slowing down our sector. And finally, look, one benefit I can see from the next 18 to 36 months is maybe we can get some things done around regulatory reform, permitting reform, reducing soft costs that are keeping things like solar from being cost competitive anywhere. I'm taking a particularly US perspective, but I do think there's some really, really big opportunities. And then I'll just leave finally with the global perspective. Spring Lane is based in Canada and the US. We're looking at deals in Europe. I do think that the sustainability transition is accelerating in Europe, in Asia, in Africa. There is not going to be a slowdown globally in the adoption of EVs or solar or efficiency or waste to value projects. If you take that long-term view, maybe we have a quarter or 2 or 3 of reduced growth, but the 3 to 5 year outlook, I think, for our sector is great. And I think as people get smarter about the missing middle, I think the outlook for how we structure unique solutions to solve the missing middle problems will get better, not just through efforts like this to educate people, but just generally investors are starting to better understand where the opportunities are in this ecosystem, and money flows to where those opportunities are eventually. It just takes a while. So I think the 3 to 5 year outlook for the climate investing sector and for the missing middle is really exciting. It is very hard to say that on some days right now, but it's really important to remember.
Thanks, Jason. Mark, you get to close us out.
Yeah, I think I was optimistic that, where we're at now will end. But that being said, if you are an asset owner and you start investing for climate for the first time, it's tough right now because your advisor or your family office is, on a quarterly by quarterly basis showing, like 2 percentage points down in your real assets portfolio, right? Just because it's tough. Interest rates are not going down. Supply chains are going to get further disrupted. Things are expensive. And then your venture portfolio is just a little flat. Why? Because we have this missing middle issue and there isn't liquidity in the market. And so you have some of those folks kind of putting their foots on the brake, which is unfortunate, their feet on the brake, which is unfortunate. I think what's going to happen during the next 3 to 5 years is kind of interesting. I do think you'll see folks investing in European asset managers over the next 6 to 12 months. I also think there will be some consolidation amongst the venture capital community because they're going to have to do so. A lot of folks put a pause on fundraising in 2023 because they saw what was around the corner. And here we are like Q2 2025, and they still have yet to raise another fund because it's not a good fundraising environment right now. How do you keep that asset manager afloat? How do you continue to invest in their existing portfolio and make new investments? So I do think there might be some consolidation in the venture broader industry. I wouldn't be surprised over the next 6 to 12 months, we start to see some innovations in the kind of continuation vehicle secondary markets as well as folks need liquidity. There's really good assets in a handful of portfolios, and maybe some CIOs at some firms want to get out, but yet someone can come in and extend that portfolio. I think we'll see some interesting things in the secondaries and continuation funds over the next few years. And so when I look at year 4, year 5, I think we might be in a pretty darn good place with very good climate asset managers who have built a robust portfolio, who have proven they know how to invest, they know how to exit, and they know how to deliver strong climate returns and financial returns, and we'll have a pretty solid industry again. But we're going to see some interesting things take place over the next 3 to 4 years to cope, at least in terms of the kind of tactical strategic decisions in the private sector.
Thank you, Mark. Thank you, Jason. You've painted a picture of a really interesting road to come and shed a lot of light into the nuances of where we're at. Thank you both. Best of luck with your funds.
Thank you, Jason. Thank you, Mark.
Yep. Thank you, Jason.
Thanks for joining us for this episode of Invested in Climate. Please remember to rate us on Apple, Spotify, or Google. Find show notes, sign up for updates, get in touch, and visualize your climate action at investedinclimate.com. This podcast is for informational and entertainment purposes only and does not constitute financial, accounting, or legal advice. Thanks again.